weekly series of shows where we tackle some of the most important issues in recruitment technology and talent acquisition and meet some of the most interesting people in that space. Today, we're going to address the topic of the state of M&A in the recruitment technology industry. And our speaker, Georgios Markakis, is the managing partner for Venero Capital Advisors. Now, if you aren't already, you should definitely be reading Georgios's posts on LinkedIn. He's one of those rare people that really has his finger on the pulse of what's happening in the recruitment technology space. And equally as important, I'm very pleased to announce that he will be our opening keynote speaker at TAtech Europe, which is coming up in Amsterdam on September 8th and 9th. We have a really great early bird discount that's in effect until June 15th. You can save 130 euros per ticket. And all you have to do is get that ticket purchased by June 15th. So do get your ticket and join us for that really important conference. And now let's get started on our event. I'd like to welcome to the virtual stage, Georgios Markakis. Welcome.
Hi, Peter. It's great to be here.
Great. Let's start with introductions, Georgios. Tell us a little bit about yourself, if you would, please, and about Venero Capital Advisors.
Yeah, certainly. So a bit about my background. I've been in investment banking now for about 20 years. Over that, I've been with Venero for about 8 or 9 years. Before that, I was at Deutsche Bank and Morgan Stanley doing M&A out of London. And before that, I spent the previous 15 odd years in the US, working at Merrill Lynch, KPMG, and actually studying as well before moving to London. We started Venero around 9 or so years ago. We're an investment bank focusing on M&A primarily. We do sell-side M&A primarily. And we also help companies with debt financing advisory and equity financing advisory. And what's interesting with us is that for the last, for I guess maybe for the last 7-ish of the last 9 years, we've been focused exclusively on HR tech and work tech. And we've been ranked number 1 in this space by number of deals. We've done more deals in this space than anybody. So yeah, hopefully I can safely say that we know the space well and we have the finger on the pulse of what's happening. And I'm glad to share some of that with everybody here today.
Terrific. Okay, so your company's website says, quote, with venture capital pouring billions into autonomous AI agents and platforms tailored for the deskless workforce, the rules of the game are changing rapidly for founders, investors, and incumbents alike, close quotes. So what are some of those new rules?
So the way we see this, what's happening today, we're in the midst of pretty significant change in many dimensions. But at a high level, we view this as the largest potential redistribution of market share since cloud, since the transition from on-premise to cloud. So there's a tremendous opportunity for companies to gain market share or lose market share. This means that the rules of the game have changed. The rules of the game in fundraising, the rules of the game in M&A, and of course the rules of the game in go-to-market strategies. We can talk about all these things, and I think we can dive into each of these and talk about each of these for quite a bit of time. But in a nutshell, the bar has shifted upwards or the benchmark has shifted upwards when it comes to what investors expect out of companies, what buyers expect out of the companies that they acquire, and also what customers expect out of the software that they purchase.
So can you give me an example of what are the higher expectations that investors have for companies at this point?
Yeah. We are coming out of a period of at least, call it, since 2019 to 2023, or 2018 to 2023 was a period where it was quite easy for companies to raise funding and even exit at very high multiples. From 2023 to 2026, the KPIs that investors and acquirers were expecting changed. So, for example, people were looking at retention, right? If you're a SaaS business, as an example, they were looking at net revenue retention, and they were happy with 100% plus. Now we're talking about expectations of, well, first of all, people don't even look at net revenue retention to begin with. They look at gross revenue retention, which is a much tougher metric to meet, and they have higher expectations for what we call GRR than historically, right? So enterprise software, if you have an enterprise SaaS business, people expect 93% plus gross revenue retention, which is a pretty high bar to meet. Yeah, where people expect net revenue retention of 110% plus, which maybe even 120% plus. Profitability expectations have changed. Whether you're a SaaS business or a job board or anything, people now, they no longer justify highly loss-making businesses the way they did, a few years ago. They used to talk about the rule of 40, now people talk about the rule of 60. So it's things like this, that metric, and then, and of course, growth, right? Growth rates. When you have AI businesses that are growing hundreds of percent every year, right? The bar for everybody has moved, right? If you're looking to raise funding and you're growing at 15 or 20%, that's a very tough place to be. When some of your AI peers are growing 500% a year. So that's how things have changed. And also, from an M&A perspective, right? Again, when buyers are looking at targets, again, they're looking at profitability much more seriously than before. And again, they're looking equally at GRR and NRR, AI defensibility against AI. They look at all these things in quite a bit more detail.
Does the changing environment around regulatory regulations, both in Europe and the States, have an impact as well?
So the short answer is, for M&A and fundraising, not really. Okay, it's very important for customers, and it's a second level DD item, but it's not. I wouldn't say it's a tier one gating item for in the context of M&A or fundraising. People expect, obviously, people to be compliant with rules and regulations and GDPR and all the and all the developments around AI and explainability, especially in recruitment and so on and so forth. They're critical items. But I would in the context of M&A or fundraising, I would characterize them as kind of a next level diligence versus the kind of tier one items, which is really just quantitative KPIs.
Gotcha.
Yeah.
The reason I ask, of course, is that in the European Union, the seemingly shifting level of regulatory oversight, and in the States, it's really just starting to emerge. So that creates a certain amount of uncertainty, or maybe even risk, for these companies. If all of a sudden they get entangled with a bunch of government regulations, wouldn't that be of some interest to prospective buyers?
It's definitely a diligence item. Yeah, it's not a valuation driver, but it's certainly a diligence item. So you go through different stages, right? Whether it's fundraising or M&A, you go through different stages. But once you've gone through the negotiations and the heads of terms and all those things, you go into diligence, and of course, all these aspects are diligenced quite heavily. They're super important. They're just not valuation drivers.
So you mentioned that your organization focuses on HR and work tech. But at one point in a previous interview, you said that recruitment tech is probably the one area facing the most uncertainty. Why is that?
Yeah. So recruitment tech, it's such an active space, right? And it has been for the last several years. It has received probably the most funding of all the HR tech subsegments, and it has been the most active from an M&A perspective as well. What's happening today is that recruitment tech, it's probably the most affected by because the use cases for AI are just a lot more evident in recruitment tech. Certainly on the SaaS side of things. On the job board side of things, it's more about the impact of mass applications and whatnot. But certainly on the SaaS side of things, AI has come to really be deployed across a number of use cases. It used to be that companies needed a lot of time and resources and expensive software engineers to build AI capabilities. This was back in 2020, yeah, or even 2019, 2020. But now AI agents and AI capabilities have become much more commoditized, which has upended everyone, all the, if we can call them incumbents, right? If we can call early stage companies now suddenly are becoming incumbents, but all these guys, they're being disrupted, right? So they themselves need to refresh their tech stack. Of course, everyone has changed their marketing, right, on their websites, but everybody feels the disruption, yeah, and everybody sees both the opportunity but also the competitive threat. We see a lot of companies coming to market from what they perceive as a position of weakness. Equally, we see a lot of other companies coming to market. When I say coming to market, I mean in the M&A market. Well, equally, other companies come to market as in going after customers with the revamped products and so on and so forth. This just leaves everybody. It just makes it that much harder for everybody else to differentiate based on AI capabilities or thinly veiled AI wrappers, and that has just really changed the game in recruitment tech.
Yeah, I was interested to hear you say that from your perspective, a lot of the funding, I think you even said most of the funding was moving into recruitment tech. I would have thought that the majority of funding, at least historically, has gone into HR tech, talent management, talent performance, those kinds of technologies, not as opposed to, but rather than talent acquisition. So if if the situation is that there has been, at least in the relatively near past, a pretty significant investment into recruitment tech, what do companies need to do, in your view, to position themselves to be attractive to prospective investors who are looking at that space?
So by our definition, recruitment tech falls under HR tech. So it's a subset of HR tech. Look, recruitment, the reason why recruitment tech has received the most funding historically and the most M&A is because it's quite there's kind of a broad spectrum, right? Ranging from job boards to a lot of point solutions to a lot of integrated solutions that tackle part of the funnel and so on and so forth. So it's a very broad space and it's a very large market. So there's a lot of providers in there. Not that in the other HR tech segments there's not as many, but recruitment tech, perhaps naively, is perceived as an easy space for someone to launch a company. And equally, it's been a problem for customers for quite a bit of time. And despite all the funding and despite all the efforts, for the longest time, people felt that recruitment was still quote unquote broken, which is a word that a lot of people have been using. Just because companies and customers have been having a hard time finding qualified candidates. So there's been a lot of activity in the space, which brings us to today, right? If someone's looking to raise funding, so we'll talk about funding first, and then we can talk about M&A. But if someone's looking to raise funding, well, the first thing they need to do is decide what will be their competitive advantage here. At the end of the day, investors look at metrics, right? So they will look at your growth, and what is driving that growth is a second level question. But ultimately, investors will need to look at your trajectory and say, look, these guys are doing something right, and they're growing really, really fast. Yeah. So VCs, they value growth, they value momentum, yeah, and they're looking for outsized momentum. Now, how do you get outsized momentum? It used to be sometimes product-led growth, which in today's environment is becoming a bit more difficult. So what we think differentiates folks is domain expertise and perhaps a niche, right, that you're able to take advantage of. But for VC funding, you just really need to demonstrate that growth, either through great execution or through some other niche or other differentiation. For M&A, you really need to find what we call that motivated buyer, because there's a lot of companies out there, a lot of buyers that are looking to make acquisitions. They are now less inclined to make acquisitions of what they could be perceived as a feature, because now it's that much more easy to develop features internally, organically, rather than acquire them. So for companies to have an advantage in the M&A arena, you need certainly, ideally, to find that motivated buyer. What's a motivated buyer? A motivated buyer is someone who is looking for a product that exactly like the one you offer, catering to the ICP and the target customer that you're targeting in the same geography, right? Ideally of size, right? So they need to be acquiring something that is at least size, I would call it 5 million in revenue, in top line is probably the bottom end of the range, ideally 10 or more. And if you're also profitable, then you're doing very well. Growth rates can be lower for M&A for fundraising, so you don't need to be growing 200-300% to get acquired. Quite the opposite. Buyers might hesitate if a company is growing that fast because the valuation expectations would be very high. So you can be growing 20%, 30%. That's absolutely fine from an M&A perspective. And then if you're a SaaS company, again, we talked about your retention metrics and all those things and how they need to stack up. But that's what companies need today in order to stand out in the VC arena or in the M&A arena.
What about private equity? You did a post on that particular topic, where the private equity market is right now. Is that a realistic source of funding at this point in time for recruitment technology companies?
The number of private equity buyers or growth equity, I mean, just the private equity guys, they tend to operate in the large cap space, so several hundred millions plus. Growth equity, they tend to operate in the tens of millions to a few hundred million. So private equity or growth equity are super actively looking today, but not necessarily transacting, right? So we see like a lot of them, right? Requesting information, going into the details and so on and so forth. But the bar, again, for the deal teams, right, to get approval from their respective investment committees, that bar is, again, quite a bit higher, especially in recruitment. Yeah, in recruitment, a lot of investment committee members ask the questions, hey, what's the threat from AI here, right? What's the impact on employment even, right? What's the impact on the future growth of the business. So they're asking really tough questions, especially in recruitment. And I think there's more than a few financial buyers that, as a matter of part of their investment thesis, actually exclude, recruitment tech for that reason.
Interesting.
Yeah.
Well, that's a good segue to a phrase you have, I believe, on your website: operational software categories commanding premium all-cash valuation multiples. Does recruitment tech even fit into those? Is it one of those categories? And if not, what might change to make it more likely to be included? Or if so, how does it improve its position?
So look, recruitment, they've had a tough few years. Like, I think everybody on this session knows this, right? Recruitment has been tough for the last 3 years even, which means for a lot of companies, their KPIs have been lagging, and as a result, when it comes to fundraising, they've been having a hard time raising a lot of those companies, and equally M&A valuations have been impacted. Nonetheless, for someone to achieve that, certainly in an M&A, because VC, like fundraising and M&A, they're two very different scenarios. It's quite easy for someone to raise funding at a high valuation, subject to the terms that accompany that fundraising, right? I think VCs will tell you, pick any valuation you like, as long as you let me define the rest of the deal terms. Yeah? So let's set VC funding aside for a second, but for M&A, it really comes down to the motivated buyer, in this environment particularly. Because the motivated buyer, that's the one who will move faster, and the motivated buyer, remember, has a mandate to make this acquisition. You are exactly what they're looking for, right? In terms of size, product fit, ICP, and geography, and so on and so forth. So that motivated buyer will move faster than everybody else. Yeah, they will pay a premium versus all the other potentially less motivated buyers, or maybe opportunistic buyers, and they will pay cash most of the time. Yeah, and typically strategics, they tend to pay cash, especially the larger ones. So it's definitely doable. You just need to be talking to the right party. And when it comes to valuation, I think there are two main drivers. We talked about kind of growth rate being a driver, and retention and all those things. But I think the two things that trump all those KPIs are timing, market timing, and internal company timing. What do I mean by that? Market timing, if we were in a bubble, right, versus, look at pre-COVID versus post-COVID, that market timing made a world of difference to companies that came to market. If you're transacting December 2019 versus March 2020, huge valuation difference. Same company, but different market timing. Okay, so market timing is crucial. And the second thing is company timing. So where are you on your growth trajectory? So timing is one of the two most important drivers of valuation. Probably number one is who's on the other side of the table, right? That motivated buyer. That can trump all the other KPIs that you have. You may not have great KPIs, but if you're talking to a motivated buyer, they will overlook those. They will look at the pro forma, right? Financials of the company. I remember a situation, we were selling a company, it was barely a year old, okay? But the party that we were talking to really needed that company and that team to win a contract worth hundreds of millions. And guess what? They paid like an obscene amount of money, right? Because that was a highly motivated buyer. And yes, if we're in a bubble, maybe you don't need motivated buyers because everyone pays high multiples. We're in a bubble. But today, when Workday trades at three times LTM, last 12-month revenue, you need that motivated buyer to get that high multiple.
So you mentioned Workday, and of course it did the acquisition of Paradox, and SAP SuccessFactors acquired Smart Recruiters. Excuse me. So it is in your experience, is the most likely set of motivated buyers HR tech companies looking to fill out their portfolio, particularly since, at least from the perspective of those of us in recruitment technology, that's been their weakest area with regard to their end-to-end platform. So they need to plus that up because, as you mentioned earlier, some companies, a lot of companies, are having a hard time filling openings. So they need, HR tech needs recruitment tech, and they are likely, I would think, to come to the table and be pretty motivated. Is that reasonable?
Yeah, that's absolutely right. The motivated buyer typically will be a strategic that has the mandate to buy and not build a particular product or a particular business. There are, of course, other buyers, other buyer types, right? There are companies that do roll-ups, right? There are companies that do vertical integrations. So you need to think a bit more creatively to find that motivated buyer. And a lot of times, the most motivated buyer is probably a non-obvious buyer. Because the obvious buyers, a lot of times, have the domain expertise to build that themselves. The non-obvious buyers is someone who is not in the recruitment space or even an adjacent space yet, but they're thinking about moving into that space. And the only way they can do this is through acquisition. They, a lot of times, are much more motivated than what could be an obvious buyer, and they can sometimes, pay significantly higher multiples than the former. And we've had examples with this. I mean, when I won't name names, but it was a recruitment tech business that was acquired by Bullhorn, and we spoke with another strategic, and they told us, God, there was we weren't at the table. We really wanted that asset, and we were willing to pay a good multiple. Now, the business transacted at an okay multiple, but from my conversation with them, they were prepared to even outbid that part. So, but they were non-obvious buyers, and they never got a call. In fact, I don't think there was even a process in that particular situation. But that's an example, right, where a non-obvious buyer can actually be can outbid a lot of other parties.
Well, we're coming to the end of our time together. If one of the companies watching our show today were thinking about looking for an investment, whether it's by a private equity company or a VC or some other source, what would be your counsel as the best place for them to start? Get their KPIs in order, or what would be the most important single first step for them?
So I would say the most important single first step is to understand what context you operate within. You cannot get your KPIs in order if you don't know what KPIs you should be aiming for, right? The rules have changed. They were different 2 years ago versus 2019 and 2020. They had already changed, but they changed again. So the first step that anybody needs to take is to understand what's the context in which they're operating today, whether it's fundraising or private equity or M&A. So talk to people, talk to advisors, talk to investors, get a sense for what are the expectations, and then you can map your course for how to achieve whatever your objective is.
So do your homework.
Do your homework. Things are moving fast.
Well, listen, thank you very much, Georgios, for being with us today. To all of you out there, as I mentioned at the outset, Georgios is going to be our opening keynote speaker This is just a taste of some of the topics that he'll cover at TAtech Europe coming up in Amsterdam on September 8, 9. And as he just said, between now and September, the world will change again. So it'll be important to have his right at the moment perspective on this very important topic in our space. So, Georgios, thank you again for joining us. Please, for all of you out there who are watching, come back again next week. We're going to be doing thought leader roundtable on the topic of, does our industry, the TA solutions industry, have a trust problem? Trust among job seekers, trust among employers, trust among other stakeholders in the process. So come on back for what I'm sure will be a fascinating conversation next Tuesday, same time, 11 a.m. Eastern, and we'll look forward to seeing you then. Bye-bye, everyone.
Thanks for having me, Peter.